Reverse mortgage or HELOC, home equity line of credit. Which one is better for you? One gives you freedom from monthly payments. The other one gives you ability to access cash in your equity. But the wrong choice could cost you. Let's clear that up. Hey, I'm Josh, and I help homeowners 62 and older unlock the equity in their home without the confusion. Today, we're breaking down the difference between a reverse mortgage and a home equity line of credit, or HELOC, to see which one fits your financial goals. If you're a homeowner, you've probably heard of both terms, whether it be a reverse mortgage or a home equity line of credit. Both of these are pretty known terms when looking to pull cash out of your equity. But which one is better if you're looking to do home repairs, pay off some medical bills, or just live easier in retirement? Choosing the wrong choice could either lead to monthly payments you can't afford or losing out on equity that your heirs are expecting. Let's go through the breakdown. What is a HELOC or home equity line of credit? Think of a home equity line of credit like a credit card against the equity of your house. So if you've opened up a home equity line of credit of, let's say, $100,000, you don't get access to that full $100,000 until you're ready for it. Usually these programs are going to come with what's called a draw period. So you're gonna have anywhere from a 2 to 5 year, sometimes longer, depending on where you get your HELOC, draw period of where you can actually pull the funds from your HELOC. So if that HELOC is $100,000 and you have a draw period of, let's say, 3 years, you have 3 years to withdraw up to $100,000. Now, that's not saying that you need to pull the full $100,000. That's just giving you the opportunity to pull up to that amount within that 3-year period. Now, one thing that you want to know is the more money that you draw out of the HELOC, the more your monthly payment is going to be. Your monthly payment is going to be based on almost every $10,000 that you withdraw from that HELOC. So every time you either pay down the balance or you increase the balance, your monthly payment can actually change based on how much you've pulled out of that credit line. What is a reverse mortgage? A reverse mortgage is a program specifically designed for homeowners 62 and older to withdraw and access the equity in their house without having to make any monthly payment. You stay on title, you own the property, you only have to repay this mortgage once you sell or pass away. Now that we know what both mortgages are, there's a few key differences. One, a HELOC is eligible for any homeowner. There is no age cap as long as you own your home. A reverse mortgage has its age limit. They go down to about 55, but generally you're gonna see most options 62 and older. When it comes to monthly payments, your home equity line of credit is going to have a monthly payment, whereas your reverse mortgage is not. When it comes to qualifying, you actually have to qualify for a traditional mortgage basically when you're getting your home equity line of credit. So good income, good credit. Whereas with your reverse mortgage, this is flexible qualifications. As long as you have enough equity in the property, they're actually not looking at your credit score and your income. They are more determining your qualification based on how much equity you have in the property and how financially stable you are to take care of the property once that reverse mortgage is active. What about repayment? Home equity line of credit, again, you have to pay whatever you use. So if you've used that full $100,000, you have to pay back that full $100,000. Whereas a reverse mortgage, if you receive $100,000, you don't actually have to pay that back until you pass away or sell the house. What is the impact of the actual mortgage on the actual house or the real estate in general? A home equity line of credit is going to have very little impact because what you're going to do is you're going to get an appraisal done on the property to determine how much equity you can actually access based on what you already owe on the house. Whereas the difference with the reverse mortgage is this is going to have a larger impact on the equity that you actually receive or have in the house. You still have to get an appraisal with a reverse mortgage to determine how much equity you have. In order to get a reverse mortgage, you have to have significant equity in the actual house. So there is a lien against the property. That loan, that reverse mortgage is going to grow over time because there is going to be an interest rate associated to it, and it's going to grow on the back end. As you're not having to pay on the actual program or the actual loan, it is still going to grow. And when you pass or sell, it does have to be paid off. So which program is right for you? Choose a HELOC if one obvious answer, if you're under 62 and you can't even utilize a reverse mortgage, but also if you have strong income and credit and can make those monthly payments with no issue. You will also have the short-term flexibility and ongoing access to that capital in order to utilize to to whatever you may need it for. Choose a reverse mortgage if 1, you're over 62 and older and you have significant equity in your house. You want to eliminate your monthly mortgage payment because maybe you are on fixed income or you don't have any income coming in, but you have that equity in your house to tap into. You need a long-term solution with no required monthly payments, and you're looking to stay in the home. In conclusion, there is no one-size-fits-all mortgage. Every situation is going to be different, and a reverse mortgage may be the right option for some, while as others it's not. If you're looking to compare options, if you have detailed questions, please contact me, reach out anytime, or comment your questions down below. If this video is helpful, please like and subscribe. Thanks again for watching. I'll catch you on the next one.